Hello traders, you're welcome back to the Forex Geek channel. Are you tired of chasing trends and getting caught in fake breakouts? What if you could time your entries at the perfect moment, buying low and selling high with precision? Well, in this video, we're just going to be diving into the Mean Reversion Channel, or the MRC Indicator. MRC short for Mean Reversion Channel Indicator. All right. So we're going to be looking at this indicator to show you how to master market reversals like a pro. Okay. If you are new here, make sure to hit that subscribe button and turn on notifications, because we drop the best Forex trading strategies to help you level up your game. Now, let us just quickly get straight into it. The MRC indicator is a powerful tool designed to identify overbought and oversold market conditions. Instead of chasing trends, this strategy focuses on price extremes. That is where the market is likely to snap back towards its mean. All right. So imagine a rubber band stretched too far in one direction. Eventually, it has to snap back, right? So the market works the same way. The MRC indicator helps us find those stretched conditions so we can enter at the right moment. Okay? So when price moves above the upper boundary of the MRC, when price moves above the upper boundary of the MRC channel, the market is considered overbought. So we actually had an overbought condition around here, right? Meaning that it's at a level where sellers may step in. And you can see shortly afterward, we had a decline, right? Conversely, when the price drops to the lower boundary or below the lower boundary, right? When the price drops into the lower boundary or below the lower boundary, the market is considered oversold, all right? Signaling a potential buying opportunity. So we had an oversold condition around here, and you can see that it actually was a good buying opportunity, and you see that the price climbed up. Okay, so this strategy is great for ranging markets where price bounces between support and resistance. All right. Now, how do we trade it? Very simple. We wait for price to enter an extreme zone, then look for confirmation. Once price enters an extreme zone, then we confirm our trade with additional signals like candlestick patterns or divergence. Okay, so for a buy trade, we wait for price to enter the oversold zone, then we look for a bullish confirmation like a hammer candle or bullish divergence on RSI. Okay, for example, here we can see that we had a pin bar here, right? You can see that we had a pin bar. Okay, had another pin bar here, right, before the rally took place. Then for a sell trade, we wait for price to enter the overbought. When price enters the overbought zone, then we look for bearish confirmation like shooting star or bearish divergence or any other bearish pattern that you can find that will validate the sell move that is about to happen. Okay, now it's also important to pay attention to risk management. Okay, like any strategy, risk management is key. All right, not every overbought or oversold signal leads to an immediate reversal. Okay, so to avoid false signals, consider using higher time frames to confirm setups. So you can see that I am currently on the 4-hour time frame. Initially, I was on the daily, and then I dropped to the 4-hour at some point. So it's important to start your analysis from the higher time frames because signals are usually stronger on the higher time frames. And then you add support and resistance zones, okay? Add support and resistance zones to the chart for confluence. When you notice an area where price usually gets to and stall or gets rejected, identify those zones because those zones are support and resistance zones, important zones on the chart that could come in very handy in the future. And also, set your stop losses just outside the MRC channel. For example, if you're going to enter a sell around here after getting your confirmation, your stop loss should be outside the channel. And then, of course, your take profit can be within the lower channel, right? The oversold territory, that's for a sell. But if you're entering a buy, for example, after you get your confirmation, you can enter a buy trade, set your stop loss below the channel, at the points where you entered, below the channel around that point, and then your take profit can be, within the overbought territory. Okay. It's important to always protect your capital, so make sure you make use of stop losses. All right. The MRC indicator is a great way to catch high probability reversals without getting caught in fake breakouts. So if you apply it correctly, you can increase your win rate significantly. If you enjoyed this breakdown, smash that like button and drop a comment below if you have used the MRC indicator before. Don't forget to subscribe for more powerful Forex strategies. See you in the next video. Thank you for watching, and I look forward to having you again. Meanwhile, before we close the video, just make sure that your risk management strategies are always in place. Okay, what I mean by the risk management strategies are your account balance being an amount you can afford to risk, and then your risk to reward ratios being at least 1:2. For example, the risk to reward ratio was 1 to 2.7, 2.97, and you can see that here the risk to reward ratio was 1 to 3.66. So minimum of 1 to 2. 2 should be the minimum, okay? So that even if you have equal number of wins and losses, you're still going to be on the winning side. So that is just what I wanted to make mention of before we round up the video, okay? See you in the next one. Cheers and happy trading.